Hello everyone, and welcome to today's class on what low interest rates, gift, estate tax, GST exemption, and baby boomers have in common. So I'm Brad Sprong. I lead KPMG's trust tax practice and our private enterprise practice. And joining me today is Scott Ham, Managing Director in our Washington National Tax Estate and Gifts and Trust. And to answer the question, what low interest rates, gift, estate, tax, GST exemptions, and baby boomers have in common? Well, they all might have limited time. And I don't really mean that in a demeaning way, but we'll talk through that later today. And that is, low interest rates may not be around forever. The state tax exemption, the gift exemption may not be around for much longer. And, baby boomers are aging out. So if they want to think about wealth transition and wealth transfer, now's the time to consider that. So we'll do a quick slides on Brad and Scott and spend a little bit of time on the logistics and the CPE information. So this session has been pre-recorded. However, Scott and I will be available and participate in the session live to answer your questions using the Q&A panel. So as you have questions throughout today's sessions, feel free to ask them. And from a CPE perspective, to verify your attendance and qualify you for CPE credit, please ensure you acknowledge all attendance pop-up alerts. Be sure to complete the session survey after attending this session to provide us with valuable feedback. And then CPE credits for attending this session live will be added to your Synergy CPE certificate that will be emailed to you following the conference. And any questions on CPE, etc., please direct those to the virtual Synergy information desk. If you're watching this recording post-Synergy, this session will not qualify for CPE credit. Okay, so back to the session. The objectives today, so upon completion, you'll have an idea of 3 really fun techniques that we see a lot in terms of wealth transfer techniques and how to utilize your GST exemption. So the agenda we're going to go through, Scott's going to spend some time kind of going through the federal transfer tax and exemptions and kind of where we are today and maybe where we're headed. And then we're going to get into the 3 techniques we see a lot of use right now. Grantor Retained Annuity Trust, or GRATs, Intentionally Defective Grantor Trust, or IDGTs, and the Charitable Lead Annuity Trust, or CLATs. So with that, Scott, I'm going to turn it over to you.
All right, thanks, Brad. We're going to start off just talking a little bit about federal transfer tax exemptions. We want to get kind of a level playing field, right? I don't know what experience you have with this or don't have with this, and we just want to make sure that we're all speaking the same language as we go along. So let's start out with just what is the definition of a transfer tax. So we've got 3 different taxes that we worry about when we talk about this. The first one is that when you die, you have to pay a tax to send your stuff to other people. So that's going to be an estate tax. And we have a transfer at life. During your life, you make a transfer to somebody, that's going to be a gift tax. So you have to pay that tax. And then the third tax is one that somebody came up with because they were thinking, I can pass this on to my kid, and then my kid's going to pass it down to the grandkid, and I'm going to have to pay a transfer tax to get it to them, and they're going to have to pay a transfer tax to get it to the grandkid. If I'm trying to benefit my grandkid, why don't I just skip the kid in the middle and save a bunch of taxes? And that's what they did. And sure enough, that was a pretty good idea. And what happens when we have good ideas is that Congress comes in and says, hey, we need to fix that. And so fix it they did. And they came up with what we call the generation skipping transfer tax. And that tax is when you make a transfer to somebody who's a skipped person, and think of them as being a person who's 2 generations below you or a grandchild. Family members are always easier to do. Family members 2 generations below you, so your grandkids, are going to also be subject to a tax. And the GST tax is actually pretty steep. So right now we're at a 40% estate and gift tax rate. So if you've used up all your exemption and you have to pay tax, you're going to pay a 40% tax rate. If it's subject to GST tax, you've also got to pay a 40% tax on that. And the nice benefit of the GST tax is not only do you get to pay tax on the gift, but you have to pay GST tax on the GST tax because that was an additional gift. And so that's another additional 16%. So for those of you doing the math, and since we got a lot of accountants out there, I assume most of you did, we're up to about a 96% tax rate on a GST transfer. And if you imagine the rates were a little bit higher, 45 or 50%, you're going to pay as much in tax or more than the person's going to get.
Hey,
so
hey,
that's,
Scott,
yeah,
hey,
go ahead, Brad.
you ran through that pretty quick, so let me follow you. So if I give $1 million gift, and I don't have any, and I give it to my grandchild, and I don't have any exemption amounts left, I'm going to pay 40% on the million going to my grandchild as a gift tax. So that's 400.
Yep.
And then I'm going to pay another 40% because on the GST tax is what you're telling me, right?
Yep.
So that's another 400. And then what? I pay another 40% on the 400 GST tax I pay because that's also deemed to be a gift. So that's 160.
Exactly. Yep.
So I pay 960 on $1 million gift.
That's exactly right.
Wow. So big consequences if I don't think this through very well.
Absolutely. And that's why your GST planning becomes really important. And we'll talk about that as we go through. If people are trying to make gifts to skip persons or to dynasty trusts, as they're typically called, making sure you use your GST exemption wisely is very important. And speaking of an exemption, let's talk about the freebies that they give us, because not everything that we transfer is going to be subject to these taxes. You get a $15,000 annual gift or annual gift tax or GST tax exclusion. So you can give that essentially to pretty much anybody, and Brad and I would be happy to help if you've got some extra money and just need to make some extra annual exclusion gifts. I can get you the information. You can send that right to us. Also, if you are paying for medical expenses or tuition and you're paying those directly to the service provider, those don't get included in your gifts. So I could pay tuition for my son, and then I could also make a gift of $15,000 to them, and neither of those would be taxable gifts. So that's another freebie that people ought to make use of, and particularly when you see how much tuition costs these days for colleges. If you've got any kids in college, you know exactly what I'm talking about.
Yeah, Scott, and that's a good one too for grandparents and the like, right? Because there is no GST either, as you point out on here. So we see that quite often where, non-parents, the grandparents, et cetera, aunts, uncles, or whatever will make that payment on behalf of that child. So that's a good one to kind of keep in your back pocket. It's one a lot of people you don't really think about it intuitively off the top of your head, but it's one that people can use quite a bit.
It's good point. Yep. And then you've also got, if your spouse is a U.S. citizen, you can transfer willy-nilly between spouses and not have to worry about paying any tax. There's a marital deduction, in essence, unlimited. And also, if you want to make transfers to charity, they're not going to tax you for those. So those are some freebies that you get. And then the big one that we're going to spend a little bit more time talking about is your combined lifetime exemption. So for gift and estate tax purposes, you get a lifetime exemption. If you use it during your life, it's not available at death, but it's because it's a combined amount, but that's available for your use. And then you have a matching, right now it matches, GST exemption, which is the same amount as the gift and the estate exemptions are as well. And if you get over that, that's over 40%. So as we just mentioned, so you have a lifetime exemption, and right now it's enhanced. And enhanced is one of those interesting words, right? But it is exceptionally enhanced right now. It's doubled, as a matter of fact. The annual or the lifetime exemption amount went from $5 million inflation adjusted to $10 million inflation adjusted. So now in 2020, that lifetime exemption for everybody is about $11.58 million per person. And if you think about it as a couple, that allows you to have $23.16 million per couple. So that's a pretty big number that gives you a freebie that you can transfer and not have to pay any estate tax. Now, it's also estimated that in 2021, that number, that inflation enhanced number, is going to get up to 11.7 million. So that'll provide you an additional $120,000 worth of exemption that you can use. But you have to be kind of prescient to make sure you know what's going to happen in 2021. Because as you're all aware, big election, and assuming there's a blue wave, or there could be a blue wave, the Democrats may have some plans to change some of the plans that are currently in place. So even if nothing else changed, at the end of 2025, the enhanced exemption disappears and we're back down to the $5 million inflation adjusted, so less than $6 million. And if something were to happen and the Democrats could put some programs in place, and remember, if they get a chance, they can do that. And they don't need 60 in the Senate to pass that. That's the way that the ACA, Obamacare got passed. It's the way that the latest Tax Act got passed on the Republican side. So the way that those get passed can be just a 50. And so they'll have a chance to do something if they want. And one of the things I've noticed almost all of the Democratic candidates for president, and we're down to Biden right now, but before that, almost all of them had something in there about reducing the free step-up in basis. And so if there's something that I'm a little concerned, I think is going to be on the chopping block, that seems to be something that they are targeting as an inequity or unfairness that they want to deal with. So I'd be surprised if we don't see something come along those rates as well. But while you have it, while the boomers are here, right, we should take advantage of them and enjoy them being around. So we should use this big exemption while we've got it here too. So that's what we're going to spend a little bit of time talking about now, is what can we do with it? There's a number of things that you can do. We always encourage our clients to gift now instead of later because it allows them to get all their appreciation out of their estate that otherwise is going to be included and then taxed. If you make a gift now, you can pay the gift price now, and say you die in 10 or 20 years from now where it would be worth more, all that's kind of past tax-free in essence. So you remove the future appreciation. Now this next one, valuation discounts, is interesting because if you remember, back just before President Trump got elected, we had a 2704 regulation that came out. And what 2704 was saying is, look, if you're transferring a family business or a closely held business to a family member, we're not going to allow you to have most of the discounts that you're taking right now. We're just going to ignore those. And so you're going to have to transfer that at 100% value. And when President Trump came in, they pulled those regulations. But what I can assure you is that they're sitting on somebody's shelf somewhere. And should things change, I'm sure they can take them down. Now, they may be a little dusty. They may have to blow them off a little bit, but trust me, they're there. And that's one of the things that could come back. So making these transfers now might allow you to still have those valuation discounts where they might not be available in the future.
So Scott, what you're referencing there is a lot of folks would form limited partnerships, and they would put their family business in the limited partnership, and then they'd have limited partner interest and general partner interest, and invariably the limited partner interest would receive discounts. They don't have control, they don't have marketability, et cetera, et cetera. And so you see that quite often, and that's kind of what you're talking about, is folks were saying, hey, if that gift of a limited partnership interest is to a family member, we're not going to let you have that lack of control and marketability discounts that you otherwise would see in the general marketplace between a willing buyer and a willing seller. So they were going to get rid of that provision as it related to gifts to family members.
Exactly. Thanks, Brad. One of the other benefits you got going for you right now are the historically low interest rates. We're going to have some examples that kind of show you the power of those as we go along. But we haven't seen rates this low ever. As a matter of fact, a couple of years ago they had to make new charts because I don't think they went below 2%, and right now we're below 1%. So very low rates that really enhance some of the techniques that we're going to talk about today. In addition, there's also some non-tax benefits to setting up trusts. You can help protect your heirs from bad marriages or bad business deals. There's an asset protection involved. It also gives you the opportunity to save them from themselves in some ways, to have a little bit of control over or kind of how that money's kind of doled out. So non-tax, we always focus on tax benefits because that's what I do, right? But we have to remember that there are also non-tax reasons that some of these ideas might make sense as well. And then the final one there relates to the Kastner case, which was a state income tax case. So depending on where you set up your trusts, they may be able to either eliminate or at least defer some of the state income tax that might otherwise be due. So there's some state income tax planning that can be worked around if you're using some trusts as well. So lots of reasons why we want to do this right now, but just some things to think about.
Yeah, and that state tax one, Scott, is jumping up more and more. I see that more and more from our clients. And there's a lot of inquiries on that. So you're seeing people, some of the people leave some of the higher tax states, physically residency, but other ones are saying, hey, I like living here. This is my home. Is there another way I can help reduce my state tax liability? So you are seeing quite a few more people think about these non-grantor trusts, in states with no or low income tax. So something you guys might see more, from, the people participating in this class might see more and more in the next few years if we keep going down the route of higher tax rates at the state level.
Right. And on that one, they come in and then you've got somebody who's living in one state. They're not related at all to the state where their trust is filing the return. So you may see more and more of that. Things to consider, kind of the other side of the coin, is that if you do make those transfers, you're going to give away that free step up on basis at death. But again, that may, that I think is under assault. But for now, you may lose that step up. And it's possible that there might not be any sunset. Who knows? Last time they didn't predict who was going to win. And this time, even if they do win, they might not be able to get something passed because they can't agree. You just never know what's going to happen. So there is a possibility that, there's a full repeal. And so you would have, done this and then didn't have to worry about it anyway. But those are all things that, may or may not take place, but just things to be concerned about, that they're on the other side of that coin. Make sure you understand that. All right. So now that we've talked about what we can do with our exemption, here are some, excuse me, sorry about that. So now we're going to figure out what we can do with that. And I think the number one is that you take care of the low-hanging fruit. You don't need to go to big steps first. Let's just start with the blocking and tackling, right? So if I've made gifts before and I haven't equalized my kids and I want to do that, boom, easy way to do that. You've got this huge exemption amount right now. Go ahead and do that. If you've made loans to your kids because you didn't want to pay tax and you didn't want to use all your exemption, well, you've got a bunch of exemption right now that by 2025 is going to disappear. You can just forgive those loans and be done with them, right? Another boom takes care of that. If you've set up some pre-existing sales, we're going to talk about those in a little bit. And if you've done it kind of skinny, so maybe it wasn't funded quite as well as you would have liked, or to make it look a little better, or to make the numbers work better in terms of the income coming off and paying off the note, you're able to make an additional gift right now without having to worry about running afoul of your exemption amount. So there's a number of things that you can do to kind of use that up. And then the last bullet on here is one that we're seeing a lot of, particularly right now, and I think particularly over the next 3 months. Folks are interested in I think the toughest thing to do is for people who are kind of in the middle. They're maybe not extremely wealthy, but they've got, $30 million, but they're worried, if I give away $23 million, am I going to have enough to live on, or am I going to have to go begging back to my kids, so that I'm not eating cat food? And so one technique that's being used is something called a SLAT, a spousal limited access trust, which will allow a spouse to get access to the assets. So I can make a transfer, I can use up my exemption, and yet because my wife is still a beneficiary of that trust, or a potential beneficiary, I can get that money too, so we don't have to eat cat food in our old age. So that's one idea that I think has a lot of traction right now for people who are in that situation. And again, I think you might see a lot more of these trusts coming across your desks. I know I have already. So that will just be aware of that. So back to GST for a second. I'm doing returns. I'm trying to figure out if I have to worry about GST, or I'm talking to a client. When do I have to worry about GST? And I think if you kind of go through a process, it's very systematic. So who's the transferor? Are they the only ones that contribute anything to the trust? Remember, GST is focused on who that transferor is. If I've got multiple transferors to a single trust, then I actually have kind of 2 trusts for GST purposes. I have to know whether, if I'm doing a Q-tip, was there a reverse Q-tip election made? Are there grandkids who can receive distributions from the trust? You just have to figure all that out from the trust. And that leads us to the middle column. You have to have the trust documents. You can't figure any of this out without it. And then you're going to want to know if it's direct skip, because there's only skip people that are beneficiaries. Could distributions be made out? And then do you meet one of the exceptions? And then the final column, which is probably the most important, a lot of times these trust documents will come to you after a few years, and now you're trying to figure out what's happened because they hadn't made any elections. And so you got to figure out, was an election made? If it was, which year was it made? The rules kind of changed on us. In 2001, this came into place, automatic allocation rules. And at first we didn't know what permanent meant. And so people did a single year. And if you didn't file in between and you made some gifts, you got a messed up GST and exclusion ratio. So that's probably, your eyes are glazing over right now as I'm talking about GST, but there's a lot of things to think about when you're looking at trusts that come through your door in terms of GST. So just make sure that you're spending enough time making sure you're doing some analysis on that, so that you know when distributions go out, whether you need to be filing maybe a GSD or a GST return with those.
Yeah, Scott, and while your eyes may be glazing over, this is probably the one area that presents the most risk to you as a trust person or as a tax professional, and your organization, whether or not you're an accounting firm or a wealth advisor or a trust department, et cetera. If GST is missed, and as the simple elections aren't made on the returns or the allocations aren't done right, it can be a catastrophic result sometime in the future. We always kind of give the example of think of some of the high tech companies where they actually made a gift early on before the value of the stock went up quite a bit, and they didn't make a proper GST election, allocation, some of their exemption. So what they thought was a GST exempt trust is not. And in the future, if that stock really appreciates and that transfer then occurs to a skip person, then you can have some, they're back to the 40% tax liability on an extremely large number in a hurry. So, and generally they're looking for someone to help pay that 40% tax, and they're blaming everybody but themselves, which generally winds up being us as the professional advisors. So it's a tricky area, lots of rules around it, but you strongly encourage, as Scott mentioned, everybody to pay a lot of attention to when people are making gifts and different trusts come in, especially when you get trust transferring in, to make sure you understand the GST implications of that trust.
Yeah. I think that brings us to our first polling question, Brad. So GST amount for the year 2020, and you can put this in the text chat. My understanding is you don't have to, because that's not how we're figuring out if you're attending or not. But you can go ahead and do that, and we'll look through the answers. I think the more difficult question here would have been, what will be the GST tax exemption amount in the year 2021 once we get to December? I didn't mention, but it has been ruled constitutional for Congress to pass a tax law that's retroactive to the beginning of the year. So even though they don't go in until January, and it takes a while to work through the tax system, who knows, the legislative system, it could be retroactive. So that's why I think a lot of people are trying to get stuff done before December ends.
All right, so we talked about on the outset in the agenda 3 items we're going to cover, 2 different techniques. And the first one is the grantor retained annuity trust. I'm going to spend a little time on this one talking about how it works, because the other ideas kind of play off this idea in terms of the low interest rate environments and stuff. So I want to make sure everybody kind of gets the grantor retained annuity trust. So just an overview of the GRAT. So the grantor establishes a trust with provisions stating that the grantor receives an annuity payment back over the life of the trust. So at the end of the trust, whatever is left over then goes to the trust beneficiaries. So what is commonly done is folks, so they don't use up any of their, it's not deemed to be a gift when they set the trust up, is they set up what's known as a zero out GRAT, meaning that the annuity amount they set as a percentage zeroes out all the assets in the trust. So at the end of the trust, there aren't any assets left. So nothing goes to the beneficiary. So you're thinking, well, that's a pretty silly gift tax planning technique. Nothing goes to the beneficiaries, and I take all the money back, so you don't get much. But by doing that, there's no gift tax exemption used, and again, because there's nothing going to the beneficiaries. But the trick to this thing, so you say, well, again, that's kind of a silly idea, but the trick is the IRS assumes that the trust assets grow at a specified rate of return. And in October of 2020, the specified rate of return is 0.4%.
Hey, Brad, can you switch to the next slide? It might help kind of visualize this for us.
Yep, I'm going to in 1 second.
Okay.
And so it's a really, really low rate. So if I form a 2-year GRAT and I want to zero it out, I have to have an annuity payment equal to $50.40 in year 1. So $100 times 0.4%, kind of divided by 2, is how I think about it. And in year 2, $50.20, because I only have $50 left in the trust. It owns 0.4%, the 20 cents. And so, so I kind of zeroed out the GRAT. That's how the IRS thinks about it. But if my assets make a 10% return instead of 0.4%, you can see after paying the $50.40 in year 1, I still have $59.60 left, not the $50 under the IRS's math. And then after paying the $50.20 in year 2, I have roughly $15.36 left, 15% of the original corpus value left to go to the beneficiary. So let's go to a more real life example, and as Scott suggested, go to the next slide. So This is a 2-year GRAT using the 0.4%, which is in the Section 7520 rate for October of 2020. And you can see in this example, I contributed property worth $50 million, and I'm going to take back two annuity payments, one $22,867,000, and the second year of $27,441,000, for a total of $50,308,000. And the IRS allows you to kind of make that second year annuity payment higher than the first. So you're good with that. And by varying the annuity payments in this way, it actually gives more time for those assets in the GRAT to grow. So a very common technique. And you can see in this, because I followed the rules, I don't have any gift tax exemption utilized. The GRAT zeroed out by paying out that $50.3 million over that 2-year period. So if you just assume a small 5% annual growth rate during that initial 2-year term, you can see that after I pay back the $50 million, I still have $3.672 million going to the beneficiaries, going to the children. And you've probably all heard the term of rolling GRATs, and that helps even magnify this technique even more. And what a rolling GRAT means is that first annuity payment comes out, the $22,867,000. I take that and start another 2-year GRAT. And when I get the next payment of the $27 million, I take that and start another 2-year rolling GRAT. So that's kind of the rolling GRAT strategy. But you can see how that low interest rate of 0.4% really has a impact on what the remainder interest is. But if you think about where we were in February of 2020, same exact example, except at that time the Section 7520 rate was 2.2%. versus 0.4% today. So you can see, the annuity now is $23.5 million, and the second year $28 million, for a total of $51.7, and the remainder interest is now $2.2 million that goes to the beneficiaries. I wanted to show you a quick comparison so you don't do it in your head, but the Section 7520 rate, you can see the difference. As Scott mentioned, these are the lowest they've ever been, and I don't think most folks think it's going to get any lower than this. The annuity payment back to the grantor is actually less, as you can see, and what's left for the remainder, so now a $1.4 million difference now gets to go to the beneficiaries because of this low environment. And if you kind of compound that out over 9 years, and you can see it's almost $2.4 million difference that went to the beneficiaries. And so we kind of went back to the title, what do all these have in common? And the low interest rate environment is, it may not be around, for a long time. So driving the point home, now's the time to do planning for wealth transition, and a GRAT is a really clever tool to use to do that. And as most folks know, GRATs have been around a long time, very, very well established, extremely low risk, from a technique standpoint in terms of the challenge for the service, et cetera, et cetera. So the only variable change that kind of pointed out on the slide here, the only variable that we changed in this example was the interest rate. And we didn't change it, right? The 7520 rate changed, and we just followed the rules to make that difference. So extremely powerful technique on this low interest rate environment.
Yeah, and Brad, the 2.2 is not even a huge number, right? It's been high. I mean, if I'd gone back 3 more months, it would have been in the 3 or 4% range. And even with those rates, it was still a very powerful technique at over $2 million, even then. But right now, super powerful.
Yeah, indeed. And so, oddly enough, back to your opening comment on potential legislative changes, the GRAT has been mentioned several times as well. And what they mention is, hey, it needs to be a longer term than 2 years. So we're going to make, there's going to be a minimum term, if you will, of quote 10 years. And the reason that's impactful is because if the grantor dies during the term of the GRAT, then because it's a grantor trust, all those assets go back to the grantor. So you haven't really accomplished anything. So the 2-year GRATs kind of help with that process. But it's one thing to watch out for. I think this, the term of the GRAT may change in terms of how short it can be, I guess, is how to say that. So to summarize the GRAT, it's a planning technique to move appreciation of an asset out of a grantor's estate without the use of gift tax and exemptions. And by the way, you don't have to zero it out. You could actually make a gift as part of that. Use the kind of the same math. You just figure out how much your gift is. So you oftentimes see people use that to make something of a gift. But it's typically established for a term of years. Short-term grants seem to be more powerful. There's lots of articles written on the benefits of a short-term GRAT versus a longer-term GRAT. You do want the issue value and some appreciation go back to the grantor. So a lot of our clients say, "Geez, I'm not sure I want to give up control yet. I'm not sure I may need the money to live on." And the GRAT actually provides that payment back to the grantor. So if they do need need financial, money to live on, they can move that back. Kind of a mini estate tax freeze, if you will. But the appreciation, as we've talked about, the appreciation amount over the 75/20 rate is distributed gift tax free to the children in their trust. And so our difference was 0.4% versus 5%. So that delta of 4.6% goes to the beneficiaries tax free. Another neat point is the grantor actually pays the tax on the trust income during the time the GRAT's around. So it's a grantor trust, so it's just deemed to be owned by the grantor, and so all the income tax liability on those assets is paid by the grantor. Kind of another way to make an indirect gift to beneficiaries, because basically you're paying the tax on their behalf on that appreciation. We mentioned this: if the grantor dies before the end of the trust term, then the trust go back to the grantor's gross estate. And we talked about the next one, potentially roll each annuity payment into a new identical GRAT. That's the rolling GRAT strategy. And that kind of helps, the probability of transfer to assets to the next generation. But we're going to spend a little more time on this, and Scott will touch on this in the next section, but it's not a good GST exemption vehicle because you can't allocate GST at the beginning of the term of the GRAT. And we'll go through that here in a minute. So not a great tool for that, but really a great tool for other things. So another polling question, if I can get the slide to move, there we go. If a grantor dies before the end of a GRAT's term, trust assets will be included in the grantor's gross estate. True or false? All right. Scott will hit the next topic.
All right. Sales to intentionally defective grantor trusts, otherwise known as IDGTs. My preference is IDGTs, intentionally defective irrevocable trusts, because I think sometimes when I say IDGT, I sound like an idiot. But be that as it may, either one of those, they're often referred to in the literature either way. So go ahead and make sure if you're searching for articles on it that you use both acronyms, and you might be able to pull up the most on it. Brad kind of walked through the basics of the GRAT, and so now we're going to look at the same kind of schedule, and you'll notice some similarities here for the sale to the defective trust. So unlike the GRAT, where we put everything in and we pull everything back out, and so our gift ends up being zero, with an intentionally defective grantor trust, we've got to put something in there that's not coming back to us. Typically that's going to be the seed money, and generally that's structured to be about at least 10% of the asset that you're going to be selling into the trust. So in this case, we're going to put $5 million worth of seed. And again, if we've got a big exemption number, $11 million, we could go higher and leverage that a little bit more. Or if we're happy with the 5, we can do the 5. But whatever you happen to do, we're sticking with our same $50 million in this case. So we got $50 million. 5 of that's going to go in as a seed. With our $45 million that we have left, we're then going to enter into a sales transaction with this trust. Now, this trust is a grantor trust, just like the GRAT was. Typically, these trusts will be structured with maybe a substitution power or a power to loan without adequate security. And those under the 671 through 679 grantor trust provisions would make this a grantor trust. And so for income tax purposes, it's going to be ignored, which is important because what I'm about to do is I'm going to make a sale. So I'm going to sell for a $45 million note back. I'm going to sell the asset into that trust. And I'm going to take my note back. And the note right now in October, there's a 0.38% midterm AFR. Now we use the midterm because generally speaking, we try and have about a 9-year term that keeps us in the midterm rate. But the rates are really so low right now that if you went up to a long term, it's not going to be a huge detriment. And so if you needed additional flexibility, you could probably do that. But we try and, generally speaking, keep them under the 9-year limit. And that allows us to have a 0.38%. Now what that means is that on a $45 million note, my annual interest payment is $171,000. So a very small number that most companies, if you've got $50 million worth of a company, hopefully you're generating enough income that that's going to easily be able to pay any type of interest payment that you're going to have to do at a 0.38% amount. So you put the asset in, you take your note back. Over the next 9 years, you're going to get back your $171,000 annually. And then at the end of the 9-year period, there's going to be a balloon note, and you're going to get back that $45 million back. So in some ways, like the GRAT, there is a return of a lot of the assets that are going in. And so it helps, again, to give some comfort to the person who's doing the planning that they're going to have plenty of assets because those assets are going to come back. But what we've managed to do is, in essence, we've frozen the value of that asset at the sales price. So anything above 0.38%, any of that growth is going to be captured inside the trust and is going to pass on to the heirs. And because, unlike a GRAT, where I typically have a very short window, here where I've got a 9-year window for that to grow and continue to appreciate, it ends up being a very big number. So that at the end of 9 years, if we're assuming a 5% annual growth for 3 years, we got to get through COVID, and then maybe we ramp it up to an 8% for the remainder of the term, then it's going to leave almost $45 million remaining for the children and the grandchildren at the back end of that trust. Very powerful, and this technique, unlike the GRAT, and we'll do a kind of compare and contrast a little bit later, but unlike the GRAT, this is not in the code. It's a little more risky, but if you are careful and you dot your I's, cross your T's, you don't underseed, this has been very successful and has a lot of people do this, and so it's a pretty well-regarded technique at this point, assuming that you're paying attention and you've got your trust documents drawn up correctly and all your notes and your security and all that. Very good, very good. Now, if we go to February, you notice the numbers changed just a little bit. So instead of 0.38, we're at a 1.75. And at 1.75, that means my annual payment's $778.5 thousand. So, $750,000 right there, or $750,000 million that has to be paid each year on the note. And you note that takes off some of the benefit. Instead of we're getting to the heirs only 37. If you go to the next slide, it kind of compares what they're getting in the end. So our interest payments went up, so it's an increase, fourfold almost, just because of the interest rate. And so your payments to the grantor are going to go up if you're using the February numbers, the higher numbers, $5.5 million. And if you factor in kind of the appreciation on that, so it's not left inside the trust to continue to grow, instead it's being passed out to the grantor, that's how you get to in the end. You've only got about $7 million that end up, or there's a $7 million difference there, a variance, almost $8 million between the two. Again, the benefit just of the low rates. So the IDIT's a great idea, or the IDGT, a great idea anytime. It can be very powerful. Look at that. You passed $37 million down for a $5 million gift. Very powerful. But with interest rates being low, it's like supercharged, right? So I'm able to get an additional $7, almost $8 million passed to the heirs, again, for no additional tax. And to top it all off, I know that in 2025, that exemption, if I didn't use it, was going to disappear anyway. So by actually using it, I've, taken advantage of what the government's given me, and I've passed additional assets to my heirs. Just very powerful, and that's why people are very interested in talking about this idea right now.
Hey, Scott, I'm going to jump back and kind of go through, and I jumped back on the slides to February 2020, but I want to kind of go through a recent client example that we just completed the transaction. In our facts were a little bit different, so I'll walk through it just so people can kind of see how this really works in day-to-day operations. But we had a land developer, a real estate developer, and his mother, who's in her mid-70s, had a bunch of U.S. Treasury securities, and she needed, I'll just use round numbers, but she needed, $30 million, if you will, a month to live on. Sorry, $300,000 a month is what she was living on, but she had all these assets that were just chugging out in U.S. Treasury interest type rates, And the family was doing quite a bit of development and wanted to do a large purchase. They wanted to buy some property worth about 60 million. And they were trying to figure out a way how to fund it and capitalize it, et cetera, et cetera. So we said, well, hey, why don't we do this strategy right here? And so we'll seed the grantor trust, and then we'll have the trust buy, you know, we kind of structure, but the trust will actually be the investor in this development. So the mother sold her securities, she bought the land, and then the trust winds up buying the land, buying the development. It's real through some partnership and stuff. I'm kind of skipping some of the nuances, but and then the mother said, well, hey, look, I have to, you know, the October rate, you know, is 0.38%. That's only 171,000. That's not going to support my lifestyle. So we actually designed the interest rate. The interest rate doesn't have to be the lowest rate. You can adjust this rate to, you know, a commercial marketable term, right? So we actually adjusted that rate high enough to give her the cash flow stream that she wanted to feel comfortable with in terms of able to live her life without kind of taking a reduction of what she's doing. So we always kind of show the best answer for the gift and estate tax purposes, but don't necessarily think about that narrow, right? So you can kind of move these numbers around, and if she had a $10 million of exemption left versus $5 million in the seed money here, you don't have to do 5 and 45. You could do 11.58, and whatever the difference is, 39 million as the asset sells. So lots of flexibility in this technique. And Scott has 9 years on here, you know, so that can be a different, as Scott mentioned, that just kind of drives the interest rate. So that term can be different. You can pay interest and principal as you go if you want, if you need that cash flow. So in our case, that's what we're going to do. We're going to pay a little bit of interest and principal as we go, and we can kind of prepay principal if you want, et cetera, et cetera. So lots of little nuances to these things, and we always show these, you know, pat examples. You know, here's what people do, but in real life, you know, people are have different needs and different objectives, and so you can kind of move these things around a little bit. So I encourage you when you see these things to kind of understand, you know, why it's set up the way it is. And if you look at the one we just did and you say, my gosh, you guys, why didn't you use the October 2020 rate? You'd have been so much better off. And, well, the answer is that didn't satisfy the objectives, you know, of the grantor. And so we were trying to satisfy the objectives of the grantor, which, you know, they want to make sure they have enough cash flow income. In addition, trying to settle the objectives of, you know, the business. So some fun things you can kind of think about when you look at these things.
Right. A lot of times they'll need a certain money, and so the balloon note isn't that appealing to them. So, you know, putting in some payments over time is lots of flexibility. Good point, Brad. All right, let's go to the summary page now. Just a couple things to hit on real quickly. We talked about the seed, wanting that to be, you know, at least 10%. More is fine, is better in a lot of cases. You're less subject to attack. A lot of people now are using guarantees instead of seed. I'm a little bit leery of that. I like to see enough cash in there to make some interest payments, so I don't have 2036 arguments about that, including those assets in my estate. And as we talked before, if you've got an extra exemption that's just going to disappear anyway, this might be a good way to make those transfers kind of tax-free as additional seed. Remember, it's a grantor trust, so you don't have any capital gain that's going to be realized, but that does mean that the grantor is going to have to pick up all the income taxes that are coming off of that. Now, the beauty of that is if you're making distributions out, chances are if you have income, you've got money, and if you distribute that out to the grantor, those are going to pay off the note. So those are kind of dual payments, right? They come out to pay taxes, but they'll also be paying off the note. So very powerful. And also, you can allocate your GST exemption to this at the time that you set it up. So when I put in that $5 million, I can allocate $5 million worth of my GST exemption to that trust, and that trust will have a zero inclusion ratio so that any money that comes out of that trust is all going to go GST free. So it's a very good technique if you're looking to use a dynasty trust and trying to get that started. Put in a seed, make a big sale, it then pays that off over time, and at the end of the note, you know, you've gotten back your note payments, but they've gotten all the appreciation, and you've passed that all into that dynasty trust that could be exempt, you know, for hundreds of years or 1,000 years or however long trust might happen to be around. So finally, let's just compare a little bit the GRATs versus the IDGTs, and they both have pros and cons, and they're good for different reasons. Right now, if you're somebody who's trying to make sure that you've used up your exemption amount, it's going to be important that you go ahead and use an IDIT as opposed to a GRAT, because your GRAT, typically those are zeroed out, so you're using almost zero of your exemption, whereas if you're trying to use that, putting in a big seed gift into your IDIT will help you use that up. They're also really good, the IDITs are, or the IDGTs, with GST exemption, as we talked about. With the GRAT, because you've retained an interest, it opens an estate tax inclusion period that won't allow you to apply your GST exemption. And so you can't allocate until the end of the GRAT, and so it's not as effective. So just encourage, if you're looking at GST, that you again fall more into the IDGT instead of the GRAT. But the GRAT's great. If you've used up your exemption, it's a great way to transfer assets for very low gift tax cost. The GRATs are going to have to use the higher AFR rate or the higher 75/20 rate, whereas the IDGTs are going to be able to use the lower AFR rates. Typically, 75/20 rate's about 120% of the midterm rate. So things to consider as you're looking over which of these techniques make sense. They're both very powerful, and they're both really amazing outcomes right now, given how low the interest rates are. So either of these are winners. They just have different reasons that you might choose one or another depending on what the situation is for your clients. So it gets us to our next polling question. An intentionally defective grantor trust is required to use which rate for the promissory note issued to the grantor, A, B, or C, 75/20 rate, the applicable federal rate, midterm, or long-term? And you can put that in the chat box. I think this is a bit of a trick question, because while A is not correct, it's possible that you could use either B or C. As Brad talked about, we can have a midterm rate, so we keep it at that 9 years, but if your client has different cash flow needs, or you think it's going to take a little bit longer to be able to pay off that note given what the company's generating, or it's a land deal and so it's going to take longer, you can actually extend those out and just use the long-term rate. I think that leads us to charitable.
It does. Thank you, Scott. And the charitable lead annuity trust, the CLAT, I again, like the GRAT, I think of them very, very similar. But rather than the grantor getting the annuity stream during the term of the trust, a charitable organization gets the annuity stream. And then at the end, the remainder goes to beneficiaries. So, turning to our example again of the $50 million, if we do, again, using October 2020, and guess what, we're going to show you February 2020 in a second, but based on a 9-year term of the CLAT, and again, that's the 9 years what we've chosen. You can use shorter or longer. And using the section 75/20 rate of 0.4%. So in this instance, the property goes into the CLAT. You then calculate what the annuity is to zero out that CLAT. And in our example, it's 5.6 million. So for 9 years, 5,667,000 is going to go to a charity of your choosing. And the remainder interest at the end of the trust term is going to go to your beneficiaries. And the really powerful piece of this is, if it's structured right, that initial $50 million charitable amount going to the CLAT can be a current income tax deduction. So that's a pretty powerful little trick. What we're seeing this a lot is in that charity, you think, well, that's going to go to a 501c3 charity that everybody knows, a name everybody would recognize. But it actually could go to your donor advised fund. It could actually go to your own operating foundation, et cetera, et cetera. So you see a lot of people set these CLATs up, and then those gifts will go to, their family foundation or somewhere else, and it'll still, enable the CLAT to meet its obligations under its rules. And so we see this used a lot. The other thing we're seeing this used a lot of is it's kind of like the residual exemption amount, right? Say, hey, I have 3 buckets. I can pay tax to the IRS when I pass away. I can make a gift to my beneficiaries, or I can make a gift to charity. And so a lot of people say, hey, I want 0 going to the government. I want it all to go to beneficiaries and charities. So you can kind of think of the CLAT as the cleanup batter, right? If I've exhausted all the stuff I can get to my beneficiaries, everything else then I'm going to send to a CLAT, and I won't pay any estate tax. So you see it used kind of as a backstop to some of the other ideas as well. But you can see here that the 21.9 million is going to the children. And if we flip to February of 2020, the exact same transaction, other than the rate now is 2.2 instead of 0.4. and 15 million go to the children. And so in comparing those together, I won't repeat the slide. You guys can see it, but it's additional 6.4 million roughly after the 9-year period that goes to the beneficiaries, and that can either go into a trust for your children or a dynasty trust or wherever it can go. So pretty powerful in this interest rate environment. And as Scott pointed out, the 2.2% is pretty low also. So you see a lot of use of charitable elite trust and a favorite technique of a lot of our clients. So I think you'll see more and more of these. Just in summary, it's a great planning technique. It helps people. A lot of people deal with their philanthropic goals and objectives while still passing assets to heirs. A client right now that's entered into a CLAT, and it's more as he believes his children have enough already, and he has had a lot of philanthropic reasons, but then this will kind of come in at a later time period for his children or his grandchildren as they get older when the CLAT term ends. So that's kind of why he's using it. But again, the grantor transfers property to a trust, designates a charity or a private foundation as the income beneficiary, and then the children or the children's trust wind up as the remainder beneficiaries. We talked about the grantor can receive a charitable donation, so that's a nice deal, and you get current recognition for the gift. The CLAT can lay out where the charity is going to go, so if you have a particular organization you're fond of, you can advise them that, hey, the grantor has made a gift to your charity, and you're going to get it over a 9-year period, et cetera, et cetera. So we do see people doing that so they can kind of enjoy their gift while they're alive. The alternative, the trust can make an unlimited income tax deduction for all gross income distributed to charity if the trust is a non-grantor trust. So we see people doing that. Again, it's set up for a term of years, and after the end of the term, it goes to the children's trust. We talked about zeroing out the trust, so there's no gift tax exemption used. That's the annuity payment. Flipping back one. That's the $6.1 million annuity payment in this example to zero out that trust, and that's just math, right? You just calculate what that is, and there's lots of tools out there to help you calculate that math. We mentioned the assets in the CLAT are excluded from the grantor's estate. So unlike the GRAT, if the grantor dies during the estate, the GRAT money comes back to the grantor. In this example, it does not. The assets are outside the grantor's estate. Again, it's kind of similar to the GRAT. It's not a great vehicle for GST. And then you kind of have to watch the private foundation rules. Lots of rules around private foundations, and then kind of outside the scope of what we're talking about today. So a good technique, and one that we talk a lot to our clients about, and encourage you all to kind of think about the same. Which leads us to our last polling question. Which is the most favorable vehicle for GST purposes? The GRAT, the CLAT, or the IDGT? So Scott, I'm going to turn it over to you to close our session.
All right. Well, that last answer was the IDGT, and I hope that this has been helpful for you. I get pretty excited when I get talking about this, so I talk kind of fast on occasion because it is so exciting, and there's some great opportunities right now. Hopefully this was helpful for you. Sorry we couldn't meet in person, but at least this way, if you were listening in your pajamas, at least we wouldn't have given you any strange looks.
All right. Thank you.
Thanks.